has announced detailed rules for exempting incremental car, home and MSME loans from maintaining the CRR, that's the cash reserve ratio. Now, the Reserve Bank of India said that the CRR will not have to be maintained for 5 years or for the tenure of the loan, depending on whichever is less. Now, this will essentially mean lower cost for banks and will help improve the liquidity situation as well. Lata Venkatesh joins us with more on that. Lata?
Yes, the RBI had announced on Monetary Policy Day that car, home and MSME loans will be deducted from the total amount of deposits while calculating CRR. And now the actual rules have come. The only important additional point we know is that that CRR exemption will be available for 5 years or the life of the loan. Now, most car loans are anyway 5 years, so the entire period of the loan. If it's a home loan or an SME loan, it will be available for 5 years, and the remaining years either the loan has to be reset or from the start the loan will have to be priced in such a way that the lower cost is available only for 5 years. Of course, they could be all floating loans and therefore they could be reset at the end of 5 years. Most bankers are happy that it has 5 years, because if the exemption was given for only 1 year, then it would have to be priced very differently. It would be difficult to price it because you have to give the exemption for 1 year and not give it for the remaining tenure of the loan. So 5 years is something people are happy with. The only, you can't say negative, the only dissonance came from bankers who said that, RBI says incremental money given for car, auto and MSME loans after the outstanding as of Jan 31st will be eligible for the lower CRR. Now, what they say is that as of after Jan 31st, a number of the loans given previously will also be repaid. So the CRR cut will not be available. Say if you gave 5,000 crore of additional loans, but 2,000 crore got repaid, then actually the CRR cut will be available only for 5,000 minus 2,000, 3,000 crore loans. But that netting is inevitable. They don't see a way out of it. Nevertheless, it's a matter of satisfaction that it is available for 5 years.
Okay, Lata, thanks a lot for joining us and giving us all those details. But let's shift focus to earnings expected later today. We have Nigel here with us to take us through what we can expect from Coal India.
Well, in terms of Coal India, the numbers will actually be a little bit subdued, but we already have a cheat sheet. Why is that? Because we already have the, the sales and the production numbers with us. Now, let's look at the expectations first. In terms of sales, well, you're expecting a contraction to the tune of around 10% approximately. The operating profit will take a harder hit. That will be down nearly around 25%. That means that the margins see a contraction of around 400 to around 500 basis points, and that reflects in its net profit as well. Let's run you through a few factors then. The sales volumes, I told you, we already have that with us. We are working with the number of around 141 million tons odd, and give or take a million tons here or there, it should be at around that number. So that will be a degrowth of around 8%. Why did this happen? Remember, the monsoons were delayed, so that's one problem that impacted the offtake. The other factor was that lower offtake from power producers because demand hasn't been that great, and also there has been flooding at some subsidiaries. But as the last couple of months have indicated, that's gradually getting sorted out. But for the past quarter, those volume numbers will be weak. Now, the key reasons for the weak numbers will be that realizations are likely to be a little bit weaker, particularly for the e-auction volumes as well as realizations. Now, on a year-on-year basis, e-auction prices have seen a sharp contraction. So, the same quarter last year, the prices were nearly around 2,700, 2,800 rupees on a per ton basis. That's come down by more than 10% odd. So, that's what's going to put some pressure out there. And also, the employee cost is likely to remain elevated. When your realizations are falling and your costs are remaining higher, that's what causes some compression in terms of margins. Also, watch out for dividend in case there's something that's announced out there. E-auction volumes and maybe some commentary that should come out from the management in the press release, because they don't talk to the press any longer. So we'll have to keep an eye on that. All in all, expect a subdued set. But valuation-wise, Coal India, very attractive. Dividend yield on a valuation perspective as well. Let's see what the stock does from here.
Okay, then thanks a lot for that, Nigel. But let's move on. Bharat Heavy Electrical, or as we know, BHEL, is also expected to come out with its Q3 numbers today. Anisha, take us through what we are expecting.
Well, it is going to be another subdued quarter from BHEL. At least what we are expecting is that last quarter we had seen a decline in terms of revenue. This time it is expected to remain flat, maybe a growth of anywhere between 1 to 2%. But the execution challenges that we have been seeing for the company is expected to continue this quarter as well. As far as margin is concerned, it is expected to inch up. Remember, last year we had seen quite a bit of one-offs. That is why the margin figure was just 3%. This time we are expecting that the number will be close to 5.2%, and consequently the profit should be up by around 11%. In terms of the internals, do remember that the company has been talking about how they are working on minimizing the working capital needs, and that is why they are letting go of revenue, and that is something that should show up in the numbers. The operating margins expansion would be led by increase in gross margins as well as lower provisions. However, do remember that in the quarter gone by, that is Q2 FY20, we had seen a big jump in terms of the EBITDA margin. That is not likely to sustain, because last time we had seen reversal of some provisions. That is not expected to happen this time around. The other key thing to watch out for BHEL is, of course, the status of the stranded orders as well as the update regarding debtors and receivables, because remember that continues to be a pain point for the company. Secondly, the update in terms of orders as well as order book will be important. The order inflows have actually inched higher if you look at the last couple of months, so we are in for some good news there. Though if you look at it on a year-on-year basis, it is expected that order inflow will be anywhere between 5 to 6,000 crores. 8,000 crore that they reported last year. So overall it is going to be a subdued state, but it looks like that the street is ready for it. Back to you.
Okay, all right, Anisha, but don't go anywhere. Industrial conglomerate Siemens, they're also going to be reporting their numbers today. Tell us, what do we expect there, Anisha?
Well, after a decent set coming in from Thermax as well as Honeywell Automation, the expectation is that Siemens should also be able to report a good quarter. However, having said that, in terms of the expectations, we're working with a revenue growth of just around 8%. Separately, the EBITDA is also expected to jump by 8% because margins are expected to remain largely flat. The profit, however, is expected to jump up by around 21% on account of the tax benefits. Now, do remember, it is the gas and power business as well as digital industries that is expected to report a double-digit growth. On the other hand, we have smart infrastructure segment of the company which should report anywhere between 3 to 5% revenue growth is what the street is expecting. Now, in terms of the margins, it is expected to remain flat, because remember last year we had seen that there was this big one-off on account of the forex gain which really supported the earnings last year, so that is not expected this time around. But in terms of the gross margins, we are expecting some expansion. Separately, the profitability, as I mentioned, is expected to go up on account of the tax cuts. The other thing to watch out for will, of course, be the order inflow number. As I mentioned, for the other peers, the order inflow numbers have been inching higher. So for Siemens, that to deliver is also important, because remember, the valuations continue to be very high for all of these companies, and the stock has run up quite a bit. Also, because they had done this recent acquisition of CNS Electric, any more word coming in on that front will also be important. So a whole host of things to watch out for Siemens as well. This time, we are expecting the numbers anywhere between 1 to 3 p.m. Back to you.
All right, thanks so much for that, Anisha. But Sonal, tell us, Petronet LNG, they're going to be coming out, they'll be reacting to a muted set of numbers today. What do we expect, in terms of reaction?
Well, it was a mixed set, Nigel. While it was a big beat as far as the margins are concerned, it was profits that were lower. So let me run you through the numbers quickly. Revenues were down 5% at 8,910 crores versus an expectation of almost 9,000 crores. EBITDA was down 5%, but margins, they were flat at 12.4%, and we were expecting a margin number of around 11.8%. That is a decline of around 60 basis points. Profits were down 39%, absolutely, maybe slightly lower than what we were expecting. Margins, they were higher despite higher operating expenses, and that is because better trading volumes helped margins go higher. However, there was a disappointment on the volumes front. So volumes, they came in at 233 TBTUs. That is versus an expectation of 240. Even utilization at the two ports, in terms of Kochi utilization, it was absolutely in line with what the street was estimating at 17%. But the Dahej utilization, that was at 98% versus an expectation of 104%. Remember, the LNG imports have been quite low in this quarter, and that is what could have led to lower volumes and lower utilization at the Dahej port. So while on the margin front, it looks really good, because the internals look weak in terms of utilization and volumes, I expect that the stock could be under some pressure today. In fact, on that note, let's listen into what Prabhat Singh, the Chief Managing Director of the company, had to say with respect to the company's capacity expansion going forth.
We are looking at an opportunity of graduating from 17.5 million ton to 20 million tons. The environment is changing. There is pricing which is coming down, and the market is indicating that there may be, on a sustained basis, prices would be low. So we would obviously be looking at other volumes and trying to see that how we address the market in terms of adjusting the current long-term contracts and trying to have a combination of spot and long-term and more long-term. Petronet LNG is looking at the Dahej. We are planning to have 2 more tanks. LNG tanks would be there, and a 3rd jetty is going to be there. Truck loading facilities at Dahej, Kochi will be expanded. And we are also trying to look at options of whether we can start loading rakes on railway. Now that is going to be, I would say, subsequent to the road part which we are doing, but yes, it is in the radar and we should be in a position to look at that option. In the, say, first 2 years, we would be looking at nearly around 40 to 50 LNG retail outlets which are going to be there. And slowly when you move to the second phase, that is the next 2 years, it would graduate to nearly around 300 retail outlets. And then finally beyond that, they should go to nearly 1,000 retail outlets. Now, all this is going to happen with people who would partner with us, with oil marketing companies, etc. today, who have already been awarded the CGDs. But Petronet LNG as such is really not looking at being in the retail business for a longer time.
Okay, all right. Time to slip into a short break.